It's Friday, August 22nd, 2025. It's episode 271. I'm Kevin Muir, and I got no Patrick, but I got something even better. I got Harris Kupperman, a.k.a. Kuppy. Thanks for coming on, buddy.
Hey, thanks for inviting me. It's been a while.
Yeah, it has been a long time since you and I have chatted. And the reason I reached out to you and invited you on the show was because you recently wrote an absolutely terrific blog post that
thanks.
It just absolutely, it really spoke to me. But before we talk about that, I wanted to talk about one of your tweets that went viral recently.
Oh, God. Which one? I'm terrified.
Yeah, no, the one where the day in the life of a hedge fund trader. And it was, for those who don't know, go find it on Harris's Twitter account or X account. I don't know what I'm supposed to call it these days, but it was funny. It was hilarious. And I think it really resonated with folks because it felt so real. Why don't you tell people just kind of briefly what it was about?
Well, basically, I wake up and then about every 10 minutes, Trump distracts me from what I'm trying to actually do, including, research, talk to LPs, talk to my wife, make my coffee. And he just randomly does stuff and the market moves, 100 handles. And as soon as he said something, he said something because the market's moved. And then you scroll through X as fast as you can to figure out what he said. And then you're either in sheer panic because it impacts one of your positions, or you're like, it might. Let me think about this a little. Or you're like, thank God, it's someone else getting screwed this time. And then about 10 minutes later, he usually changes his mind and it just goes back the other direction. And yeah. I don't know. I used to be a really productive guy. I mean, Joe Biden would wake up at noon. He'd just give a press conference where he kind of wandered off the middle and he shook hands with the cloud, and it was great, right? It was super productive. I could sit there and read footnotes in a 10K, and now I can't look away for 3 seconds because I don't know what Trump's going to do next.
Yeah, it just really was. It was really funny, and I can't tell you the number of folks that sent it to me saying, wow, this just really, truly feels like my day every single day. So for anyone who's interested, go have a look at his Twitter account. But the real reason I got you on is because you wrote this piece saying global crossing is reborn. And I guess let's just start with, what was global crossing for those who don't know? I'm actually surprised you remember global crossing because you're a younger guy. You're a millennial. I'm surprised that you know that story, but let's just start with that. What was global crossing and why do you think that this resembles that?
Well, global crossing it's kind of a catch-all for a number of companies. You could lump Quest and all these other companies in there. And these guys looked at the internet happening and they did this math that, data usage is going to double every 3 months or something, because that's the rate it had been going at.
Yeah, this is in the late 90s or
yes.
Yep.
But it's from a super low base, right? And they said, okay, let's build the next 25 years of fiber demand today because, but I mean, there's a certain logic to it. Like if you're going to lay a fiber across the ocean, why not lay a really big fat pipe instead of lots of little pipes?
Right.
The problem is it's really expensive up front. And what turned out to happen is that while data demand grew a ton, it didn't grow as fast as anyone thought. And they all funded it with junk bonds. And then when the revenue wasn't there, these things all collapsed and guys bought the pieces at pennies on the dollar and they made a fortune actually, but it took another 20 years to fill the pipes. Some of those pipes are still dark now, 25 years later, which
is that incredible. True? I didn't know that.
Some of the pipes are still dark or they're at half usage. And I think the other really interesting thing that people don't talk about is that in inflation adjusted dollars, telecom spending peaked in revenue in the early 2000s. And as a result, I mean, despite the fact that I'm on my cell phone, 19 hours a day, revenue to the global telecom industry has actually been shrinking in inflation-adjusted terms. Not per megabyte, but just total revenue.
Yeah. Well, I had no idea about that.
Well, you have businesses with super high fixed costs, and they're fighting over incremental revenue dollar. And as a result, they're in this never-ending price battle to gain customers, and they're sort of just competing the margins down to zero.
Okay. And so tell us why you think that this provides a roadmap for us to think about at the very least when it comes to the current environment with AI.
Well, I mean, AI, and I want to just preface this by saying AI is going to be the future. I totally understand this. I'm not against AI. I'm not even against people building data centers because I mean, I use AI.
Yeah.
And I mean, this is like when they gave you free Uber rides to get you to use Uber. It was great. You know, there's some VC somewhere that subsidized, you know, my lifestyle for a decade. It was great. And this is kind of how AI is, right? I mean, I paid nothing for AI, but AI gives me all these things back. And in the end, it's really a commodity product, especially at the level that I'm going to be using it as, which is glorified search. It's a commoditized product. They're going to compete down to zero in terms of revenue. And they're going to fight over me as a customer and all my friends. And they're going to keep offering me more stuff. And, you know, I'll be a Perplexity guy some weeks. And then, you know, Grok will get incrementally better and I'll go there. And then I'm on ChatGPT. And they're just going to have to spend endless money to get me as a customer that pays no revenue. And they won't ever have a way to monetize me. And they're going to have to keep building more and more data centers because I'm just going to keep building more and more memes. And, you know, no, but there's some like family in Arkansas that's trying to run their air conditioner right now. And they can't because I'm making a meme here in Puerto Rico. Like, sorry. I mean, I actually think this is kind of wrong. Like, you know, electricity bills around the country are going up because AI is raising the price of electricity for residents. It's like this weird encroachment. But anyway, you know, in broad numbers, and I'm sure there's people who will criticize me on this. You know, I wrote this blog post. I said that they're going to spend about $400 billion this year. And, you know, if you assume a 10-year depreciation curve, they need 40 billion of revenue,
right?
Just to cover depreciation. But revenue, it's like
that's making no money. That's just covering their costs, like in essence.
Right.
To get their money back with no return.
But revenue is 15 to 20 billion now. And like we all agree, revenue is understated today because they're subsidizing it and they're trying to get you engaged in it. And I get that. Right. But I mean, revenue doesn't cover depreciation. And then if you assume there's a 25% gross margin, and the gross margin right now is highly negative, you know, so on top of the depreciation, you have super negative gross margin here. But the gross margin, even if you get it to like 25%, which is kind of crazy because when you look at, you know, other competing things like Bitcoin mining, it has negative gross margin still. And so, but if you get this thing to a 25 margin and you work backwards, you're going to need, you know, 160 billion of revenue to get this thing. Cause you know, that gets you to a 25% margin, that gets you to 40 billion of gross margin. That gets you to break even in this thing, 160 billion of revenue. And then I kind of looked at this and I said, okay, what are some really big subscription-y things? And, you know, even Microsoft Office is like less than 100 billion and everyone's on Microsoft Office.
Right. Yeah.
Netflix is like in the 30s or 40s. I don't have the thing in front of me, but like, and everyone's on Netflix. Like there's 300 million people on the thing. And it just makes you realize how I just want to work backwards. You know, everyone keeps telling me, oh, you know, just give it 6 more months and then AI will be better. Yes, it will be better. But I try to work backwards and say, how much revenue does it need? Because like it doesn't, like AI doesn't prosper on me making memes. It prospers on revenue at some point. And you need 160 billion. And then you start saying, okay, if you want to earn like a return on your capital of 20%, well, then you need like a $500 billion. And I'm not saying like AI has to eventually get to a $500 billion to be profitable or have a 20% return on capital, which is kind of what you'd want for like a capital intensive infrastructure asset, unlevered, when you have, you know, huge obsolescence risk and everything else. But that's just for the 2025 build out. And they're talking about next year, like doubling the pace of build out. So maybe next year you need like $1 trillion. And then you see like, okay, so for what the capital you're going to spend in 25 and 26, you need $1.5 trillion. And like they're at 15 billion now. And then you kind of like, well, the government, you know, they love spying on people. But like the whole Defense Department, like that's like $1 trillion. And like we're talking about $1.5 trillion. Like it's bigger than the Defense Department. And the Defense Department still needs like aircraft carriers and stuff. Like, it just doesn't square, right?
Yeah.
And then, you know, one of the great things about, you know, the position I'm in, and I'm super lucky, is I have a ton of people that are really smarter than me, and they're really grateful with their time. And, you know, I always get emails back, and some of the emails are like, Kuppy, you don't get it. Like, AI is the future. And I'm like, no, I get that. But you have some people who write back, and they're like, actually, Kuppy, you're not bearish enough or jaded enough. There's like, you know, I work in an AI startup, and, you know, we have, you know, no revenue, and we have like a 10 billion valuation. And my only goal in life is, can we limp this 30 more days and get it into a SPAC? because we don't see how we ever get to profitable. We're not even like, we're at negative revenue. We don't know how this works. And but people keep telling us it's worth 10 billion. And it's just one of the real pushbacks I got, and I always appreciate pushback, is they said, Kuppy, it's not a 10-year depreciation curve. It's more like 5. And I'm like, what do you mean it's more like 5? I have this one guy, and he works at a big data center. He's like, look, they're changing things so fast on us. One, you're saying the chips last 3 to 5 years. He's like, nah, 1 to 2 years. He's like, as the chips right now that are getting ordered from NVIDIA, by the time they show up in the warehouse and then they're put into the racks and they're all engaged, it's already an obsolete piece of equipment. Like that cycle of just turning it around and ordering. He's like these things are 18 months. And then he goes, you're thinking like the cooling system, the electrical system, and the racking system, that's 10 years. Because I mean, I don't know, an air conditioner at my house lasts 10 years. Like, I don't really know. Right. He goes, no, didn't you see what Kimura's just did? They just created this new coolant, and the new coolant means we need to do all of our flooding systems and all of our racking systems different. But we get to cool it like 20% more. And then like, there'll be some other guy with a different coolant that does, and it's like, when you have one of these data centers, it's designed in a way that you can't just like pull up all the piping is in the floor. Like, it's literally cheaper to demolish the entire data center and start again, because you're gonna have different dimensions, you're gonna have different this, different that. But the technology is evolving on power, cooling, everything else, just as fast as it is evolving on chips. He's like, maybe your other stuff is 5 years. And so you take my 1.5 trillion number and you take the depreciation and you jack it up a little. What if it's $3 trillion you need? Like, right. I mean, it's such big numbers. It's like, okay, 10% of the economy will no longer be spent on food or clothing, or, it's just going to be me making memes. Like, I don't know.
But isn't the real problem, like, they're spending this and they're going to lose all this money because there won't be the revenue. And it's actually, it hasn't reached a point where we should be worried about it as like a systemic risk to the economy?
Yes, I think there's a couple things. Like, look, you can look back at like railroads, okay? Like, it was this really cool thing that the United States did. It integrated the entire country, and they started building some of these railroads, and it was the 4th or 5th guy who finally got to actually operate it,
Right.
Like,
it's like restaurants. Like, you never make money the first guy with the restaurant. It's always the third guy who buys the restaurant fully furnished and stuff that makes all the money.
Yes. And with railroads, it's even worse. You just keep putting capital in until you finish the thing. Like, there is no revenue. Like, you can't get from, the farm field to New York to export it. Like, and so this is very much like that. And eventually, some guy buys it at pennies on the dollar, completes it, and then he makes a lot of money. It's like the Global Crossing guys.
Right.
But I think what's really interesting here is if you just look at this year, we're going to put 400 billion in. I think everyone kind of agrees that's roughly the number. Okay. You add in a bit of R&D, you add in a bit of, corporate overheads and SG&A and everything else. Am I wrong to say this is like 1.5% of the US GDP? And that's not including any of the downstream effects, and there's a multiplier to this, obviously.
Yeah.
So maybe you're at 2.5% of GDP. And then I don't think people appreciate the wealth effect. Like, we always talk about, interest rates and QE, QT. And you were super early, Kevin, in realizing that fiscal is so much bigger than monetary. But I think wealth effect is even bigger than monetary.
Yes.
I see it in friends of mine. I see it in my parents. Like, they're retired. They have no more revenue coming in, and they have to live on their savings, except for my dad's invested in a house, the S&P, and my hedge fund. He's doing well at all three. And, it's just like, I'm like, Dad, you're going to Europe again? Like, he's like, yeah, have you seen my S&Ps? They just keep going up. I'm like, and he's like, he doesn't even sell any S&Ps. He doesn't even sell the house. He actually has one of these negative amortizing-y things where, I mean, his LTV on the house is actually going down, even though he can't spend the money fast enough. And it's not even like a super nice house. It's like an upper middle class house. It's just like, every time he takes money out, like, it appreciates more and the LTV keeps dropping. And so you have this wealth effect. And I think that if NVIDIA, well, basically Mag 7, because you can ignore the other 493, those never go up. Right. You just take NVIDIA, you just take Mag 7 and Bitcoin. Yeah. And if those ever go down, and those Mag 7 are all tied to AI, if those ever go down, the wealth effect goes in reverse. So I just said that maybe AI is 200 bips of GDP this year, going on like 400 bips next year. but the wealth effect is probably, a couple hundred bips more. I mean, let's say the combination of the AI bubble plus, the actual CAPEX plus the downstream, maybe that's 500 bips this year of GDP. Where when you look at that, you're like, we're in a recession outside of that. And then if you look at the rest of the stocks in the market, you'd be like, the US kind of is in a recession. And I want to talk about that after. But then it's like, so next year it's supposed to be like 7 to 1,000 bips of GDP. Like, these are huge numbers. Yeah. And I mean, you kind of call bullshit on some of my numbers. And well, yeah, I'm probably being a little bit, flamboyant with how I approach these numbers. But I don't think I'm off by basis points. I'm not off, directionally. We're having an epic bubble in Mag 7 and wealth effect, all tied to AI, which everyone says is the future. Yet the people inside of AI, and I had about 10 people reach out to me, tell me that it's not the future, and they all went out.
I don't know. You're being a little hyperbolic there, aren't you? They're not saying it's not the future. They're just saying that the pricing is never going to be able to achieve what's priced in now. Is that not what they're saying?
Look, I have a farm. It occasionally produces an avocado or a mango. It's not going to be a profitable farm. Therefore, it has no economic value. And look, I get a lot of enjoyment out of going to my farm. It's great exercise. Every once in a while, I bring something home to my wife, and she's amazed I produce something. But like, if you were to approach my farm and you wanted to put it into a farmland REIT, they wouldn't give me a lot of money for it because it doesn't produce much of anything. And my farm is very well suited to go back into jungle. And probably when I get bored of my farm, it'll return to jungle. And I think that's how you can save a lot of these data centers at some point in the future, because the technology advances so far, whereas like fiber hasn't advanced. So the old global crossing pipes still work. When the data center of the future needs to be 10 feet taller or wider or something else, well, that is a total write-off. It's like my farm. Yeah. And they're basically saying, like, our AI startups, on one hand, it's worth $10 billion, and we're raising as much equity as fast as we can. On the other hand, we just can't figure out how to cash out fast enough. Right. We know the music's about to stop.
Okay. And I just, before we go on about this wealth effect, you're the one that's always, reminding me. You say that in the old days, recessions cause stocks to go down. And you say today, stocks going down cause recessions. I think that's a great line.
Yeah, but did I say that? That sounds too...
Yeah, no, that was definitely you. You're the one who told me that.
I'm kind of proud of myself. I must have been drunk.
No, you're the one that told me that. And I'm not sure I'm completely on board, but I'm definitely open to the possibility. And I think that the wealth effect is often underestimated. Okay, so now you're looking at this macro setup, and you're worried about AI, and that's a trade on its own. But you're also worried about the economy, and you kind of alluded to it when you said that all the growth is in the AI, and then the rest of the economy is doing badly. Can you expand on that and explain where you're thinking from that perspective right now?
Well, I mean, supposedly the statistic right now is that AI growth is faster than the growth of the consumption economy, the services economy, which is like 70-something% of the economy. This little 1% piece of the economy is growing faster than the rest of it, which is kind of, the first clue that something's misbalanced in our economy. 10% of Americans are half of our spending now. And I bet that's even, narrower. It's probably the top 1% that are a good chunk of that. The 1%, they don't earn money from jobs. Well, they do, but they get, 50% tax rate on that. So you can't really put much money in your pocket. They earn money because they have assets, and the assets go up, and you can borrow against those assets tax-free, or you sell those assets to some other idiot. And as a result, the wealth effect is such a big piece of the economy. And I think people don't appreciate that if stocks go down, people stop spending. Right. And I think it's almost immediate, guys, they're like, maybe I don't want to spend $1,000 on dinner. Or if we're going out to dinner, let's go get a cheap wine instead of the really fancy stuff. It happens really fast, and there's a feedback loop to this. And I mean, we saw this in when we had that little slowdown in 22, and all the consumption numbers just collapsed. Even though the government was doing huge fiscal, and we're doing infrastructure, and all the states were flush with money, and like the middle class, they were just going crazy. But NASDAQ came off, and big ticket items just went no bid. And it just shows you how tied to NASDAQ it is. but I really do think the U.S. economy is slowing. Um, you know, I'm one of those believers that, there's the real economy and there's the tech economy, and the tech VC economy exists in its own little bubble in San Francisco, and they have no idea how anything works, and they don't really care how anything works. And then you have the rest of the economy that uses things like plastic. And so you look at, what are the prices of like methanol and naphtha, and, you go through, TiO2 and chloralkali, and you go through all these things that are like precursor chemicals that then go downstream and get specialized and eventually end up in some product in your house. And they're all no bid. And then, look, I guess, oil's a bit, political, and the Saudis are producing a bit more, but I mean, oil's kind of no bid. It's just been a free fall. And so is lumber. And you just like start looking around the world at all the stuff that goes into stuff. And you're like, there's a big chunk of the economy that's just freezing up. And then you look at a lot of the stocks, the 493, as we call them. But a lot of those are still kind of, buoyed a bit by passive flow. But if you go to something like the S&P 600, which these are companies $1 billion to $5 billion market cap. They tend to be regional banks, which aren't really doing that great, or they tend to be, industrial things, or they tend to be basic material. That you have less of your tech stuff in there. These things are suffering. I mean, these stocks haven't really gone anywhere in almost a decade now. I mean, they finally had some excess earnings in 2021, 22, and then it all just went away. And now they're back to, earning no money. And I just think the economy is really quite slow, but people don't realize it because everyone looks at the stock market and the 7 stocks going up and everyone's like, oh, cool, everything's great. Yeah. And I mean, the employment numbers are okay. It's kind of rolling over now. I think we're setting up for a nasty recession. I mean, Kev, you and I talk about this a lot. I mean, I think it's gonna be bad. I mean, how do you see it?
Well, I'm completely in your boat here. And the thing I like when I talk to you is I'm sitting around looking at the macro numbers, trying to come up with reasons why I think the economy is slowing. And you'll come to me and you'll say, Kev, it's just on with another conference call. And like, again, no demand, falling off a cliff. And you'll have all these examples of like real world stuff that is rolling over. And that's why I love talking to you, because you are getting on those conference calls and you are listening to them. And why don't you just tell people about those conference calls and how, despondent they are, because that is like, there's nothing else to describe them, right? They're just not good.
It's like a funeral. I mean, look, I probably listen to 300 of these calls. I like tone, I read transcripts too. I mean, earnings, the 2 weeks of earnings, I just don't sleep. This reminds me a lot of summer of 2008, where like everything went no bid in the economy and the stock market was still pretty bid. And everyone's like, everything's fine, and it's just like, no one has to pay their mortgage. Look, everything's fine. The stock market's up, and like, there's a demand problem right now in the economy. It started last year on lower income. And the issue is that I really do think inflation's higher than what it's been stated at. And I mean, there's 1 billion people that can tell you, the whys and how. I'm just a human that lives. And they tell me inflation is 3%. And I wish my stuff was up 3% only. Like they just told my company that our healthcare costs are going to go up 30% next year. They like just wanted to warn us.
Right.
And it's like healthcare and the CPI officially went down. They told me it went down, and I want to buy some of that healthcare because it's cheaper than the one that I have. Right. And look, we've been a successful hedge fund. We can afford to, take care of our people. But I understand why if you're, a low income earner, you're getting squeezed on everything. Yeah. And then, it's kind of gone up the cap structure. I don't know how you want to call it. Cap structure is probably the wrong word. But it's like middle income guys now are suffering. And I just see it, like you start seeing it in restaurants. I mean, that's the most disposable. You see it in retailers. You see it in, mall traffic. Like that's all been falling off. But it started on the low end, and it's just been like going up the cap structure. I mean, it's kind of funny how you can look at like different restaurant brands, and some of them are doing great. And then some of them, just had a freeze up in Q2. And some had a freeze up in Q1. And it's just, I mean, look, when does Chipotle ever have negative comps? Like it's kind of bizarre, like some of this stuff is just starting where it's like, okay, these are middle income guys. And they're like, that's probably even like upper income guys working at an office. And they're like, $22 for a burrito bowl. Like that's getting a little pricey. I mean, I remember when those things were like $6.
Yeah.
And
yeah. No, they are getting expensive. I completely, well, most of that was COVID, but they are expensive and things aren't going as well as they used to. And to your point, the people have less money in their jeans. One of the things that we've talked about is the volatility of economic policies from the new administration. I'm trying to be politically correct here. I'll let you go do it because, I'm not even an American. So, and I definitely don't lean that way. So, but I'll let you tell people what you think about his policies and whether you think that money will be attracted to the U.S. to build plants and that this is the way you encourage more CAPEX in the U.S.
So what he's managed to do, I think, is destroy demand with tariffs and have no resulting CAPEX except for data centers. Look, he said, I'm going to support American automobile. And he puts a 25% tariff on every car. And then he goes, okay, Japanese guys, you get 15%. And all the Americans like Ford are like, hey, wait a second. Like, we're building the thing in the United States at 25% because all the parts come from Mexico. But like, you guys in Japan get to send us a finished car. And like, Ford's like, come on. And look, remember like a month ago, he's like, oh, all the copper has to be made in America. And the price of copper in the United States was like $1.50 more than the global number. And so everyone producing anything in the United States is just like, well, I could pay, was it 30, 40% more for copper domestically, or I could buy copper internationally, produce it internationally, and then bring a finished product in at 20%. And I'm sure there's all these people inside these large companies looking at this and being like, well, these are the three options. Let's do it this way. And then he changes his mind. He's like, oh shit, we gotta do it this way now. Like we had this one day where copper was down like $1.50 on a tweet. I mean, imagine someone is in the copper industry and they didn't properly hedge. I mean, I'm surprised you don't have some like metals trading firm blowing up on this. Like someone ate a huge loss there. Yeah. And then you have everyone globally that has copper inventory to do the thing they need to do. And they're like, oh, it's cheaper to do it in America now. Let's get rid of all this half-finished product we're making in Mexico and do it here. But as you can imagine, this is really disruptive. I mean, I was planning to build a copper mine. And
and then the next week you had to shelve your plans to build a copper mine.
Yeah. I mean, I was looking for copper at my finca in Puerto Rico.
And so do you think that this is part of the reason that the economy is slowing?
I think, CAPEX is a big piece of our economy, construction. I mean, you're seeing it in, everything touching construction, but you're seeing it throughout everything because no one can make a policy decision. No one even knows what to do. Like, you want to order a pair of jeans as a retailer. Well, which country do you think he's going to tariff next? I mean, do you do it in Malaysia? Do you do them in China? Do you do them in Vietnam? Like, by the time you get those jeans built and on a ship, he's probably changed his mind 3 times. Yeah. At some point, you're just kind of like, nah, jeans are so last year. So
I think that if you kind of thought about what somebody that would be on the other side of this belief would say, they go, well, look, the U.S. economy is doing well. Our stock market's at all-time highs. You don't know what you're talking about. What would you say to them?
I've been on a couple hundred conference calls and CEOs are saying there's no demand. Yeah. And it's because no one can make a decision. You can't go to your board of directors because the board of directors is going to say, what do you think Trump does tomorrow? And the CEO is going to be like, well, we really want to build this factory, but we don't really know which country to build it in because we don't know what the tariff rate's going to be. And the board's going to say, come back next quarter when you have some more visibility.
Right.
And look, I think this approach is really great if you're trying to screw some subcontractor at your condo project and you want to cheat him on his tile contract and get 15% off him. You get him half pregnant. He starts doing all your tile work. And then you throw him off the job and, you try to arrest some of his employees for something. And it's great if you really want to, just squeeze that tile guy.
Yeah.
And yeah, I mean, like, we're going out there and we're in a trade war and we're going to squeeze some guy in Madagascar who's making vanilla. And we're going to really make that guy in Madagascar hurt. And it's like, okay, there's the rest of this like $30 trillion economy that's also hurting, but we're going to save a nickel on vanilla. It's right. Like, that's Trump's approach.
Got it. Okay. So now let's go, that's the fiscal side of the situation. Let's talk a little bit about the monetary side. We're taping this. I know I said it's Friday, but we're taping it on Thursday. And so we don't know what Jackson Hole is going to be, but what do you feel is happening there? Do you feel it's important? And, what do you worry about from a monetary side of the equation?
Well, I actually think monetary doesn't really matter as much anymore. I think fiscal is what drives everything.
Yeah.
And we're running it super hot on fiscal. At the same time, we're running 7% fiscal and the economy's rolling. And it means we're going to have like a 15% deficit when the recession hits next year. Look, I think Powell is very much in his right to do nothing because no one has any visibility on anything. No one knows if tariffs are inflationary or deflationary. No one really knows. Look, a bunch of data says inflation's accelerating. A bunch of data says that the economy is falling apart, like the employment data. I mean, no one really knows. And as a result, I think he's well within his right just to say, let's see how this plays out a couple more months. I think he's also well within his right if he wanted to cut rates. I think he's well within his rights if he wants to raise rates. I think he has every option available to him because you could make the case that rates should be higher right now. I mean, I know no one even talks about that, but I just think no one really knows. And as a result, I think he's going to give it a wait and see. And he's going to piss off Trump, and that's life. I mean, the economy falling apart is Trump's fault. I don't think it has anything to do with rates. And I just don't know. I mean, what do you think?
Oh, well, when you said the fact that monetary matters a lot less than folks realize, I couldn't agree more. I do think that's really important that way. I do also happen to agree with you that that there is a good case for him to be made that he shouldn't do anything. Let's face it, he's still not at target. We're
like 5 years above target now.
Yeah, like we're still 3% inflation, and to everyone that's screaming at me saying that he should be lowering rates, I go, like, ask yourself what Stephen Moran and Scott Bessent would be saying if Kamala Harris was in power. I think that they would be saying the Fed is in danger of losing their credibility because they haven't achieved their target, and they would be talking about higher rates. But I don't think it matters as much as folks think. I do worry about, though, conflict at the Fed in terms of between Trump and the Fed, longer term damaging the U.S. financial markets, and in essence increasing the term premium. So what I'm worried about is a revolt at the long end of the bond market. And I think you and I are on the same page there, and that we both worry about that.
Yeah, I mean, I've kind of overused my Africa meme, but this is Africa. I mean, you don't want your president and your Fed banker having a battle, in the news. Like, it's just not really good for. It's usually not good for interest rates. I mean, there's a reason that interest rates in Africa tend to be at a premium to our rates. I mean, their cost of capital is higher because, it's Africa. Yeah. I'm embarrassed to say it, but I actually think the coming recession will be so nasty that the visceral and knee-jerk reaction amongst people will be to reach for bonds early in this process, just because that's what's worked every other time and every other cycle. Yeah. I think it's a trade long bonds. I mean, I'm embarrassed to say it. I mean, I almost want to puke in my own mouth, but I'm long some bonds. By the time you see this, I may be out of the trade, depending on what they say at Jackson Hole. But I actually think bonds can rally here because I think the recession is going to be so nasty. And I think that they're so boxed in. I mean, look, Kevin, when I coined the phrase Project Zimbabwe, I said it's going to go up. And it's not going to really matter if the economy is good or bad. They're just going to throw so much fiscal and monetary at it. And I remember you and I were in Canada at a huddle event, and everyone told us how wrong we were. Yeah. And I'm telling you, just like I do all this earnings call thing, I'm like, look, I talked to a lot of these management teams, also, off the call, and they're like, my backlog is growing, everything's accelerating, like we're hiring people, and so like. When you have a super tanker like this, a big corporate, it doesn't just turn around. Yeah. Like you have visibility for 2 years out that things are going to be awesome. Yeah. And it was just obvious that we weren't going to have a recession, that things were going to accelerate. And you said the same thing. And we were with a room of huddlers telling us that we're wrong. And now I feel like everyone gives me some variation on this. Nothing stops this train. Nothing stops this train. And I don't mean to single anyone out. I mean, that's basically my phrase, except for I'm saying I think it's stopping.
Right.
And I don't really know what to think or say, but everyone's absolutely convinced that we're just going to go run it hot. And Trump's trying to run it hot. And I think people forget that when you run it hot, there's reasons why we don't just, do Spinal Tap 11 full, for like that's not how you run an economy. And the reason for that is that eventually, with unequal lags, there's side effects. Inflation is one of those. Your cost of capital starts going up. I think one of the reasons why bonds have sold off is that a lot of people are looking at other options. They're saying I can get, 4 and change in a 10, or I can get inflation protected 10 owning, some sort of US equity that's trading at 25 times earnings and, paying me 2 in dividend plus 2, 3 in growth, real growth. And so I'm getting this inflation protected bond, plus I'm getting a little bit of growth. It's a better product. And I mean, you kind of have this weird crowding out of the, equity markets crowding out bonds. I think you end up with a multiple compression though, too, because as bond rates go up, if you run it hot, because the equity's crowded out, you start to get this multiple compression. I mean, we ran it hot throughout the 70s. Remember, Guns and Butter, Guns and Butter.
Yeah.
And I mean, look, everything traded at like high single digit multiples. I mean, that's why private equity, back when they actually did creative, interesting stuff, they would buy these companies at 7 times earnings and sell off divisions and move stuff around and made a lot of money doing it. But everything was 7 times earnings because interest rates were higher and we were running it hot. Like getting from mid-20s earnings down to 7, I mean, that would break the world.
Yes, it would really cause a lot of problems. All right, one last topic I think that you highlighted that we should chat about is trading in a slump.
Yeah.
And I'd love to, you penned another blog that was very, very well received about the difficulties when things aren't going your way and just the human element. So I'd love for you to kind of expand on that and talk about the challenges that portfolio managers and all investors face.
Right. I mean, look, to preface this, we're doing just fine. I mean, we're actually up on the year.
You are like, I must say, I just to set the stage clear here. Kuppy will be the kind of guy who'll be bitching about how he's not doing well. And then I ask him and I'm like, what the hell are you complaining about, buddy? Like, it's like, you're still better than most people. Like, this is terrific. Anyway, so I'll just completely say that, like, when Kuppy is getting mad at himself, it doesn't mean that he's actually like had a bad year in terms of like how most people think about their bad years. He's just very hard on himself.
Look, I set really high expectations for myself. This is a hobby. It's a business. It's a point of personal pride.
It's your life passion.
Yes. Yeah. And I don't feel like I'm doing as well as I should be this year. And I think you say the same for the last couple of years. And, eventually it kind of, gets to you. It's like, what am I doing wrong? What am I missing? I think, you do a lot of introspection. I mean, the first step is when it's not working, you kind of pull back. You just pull back all the marginal positions you don't want, right? All those little things that are distractions. And you start going through the core book and you kind of say, why do we own this? What do we really think? What's really happening here? It's super helpful just to go away for a month and just do something else. I mean, focus on your eating and your drinking and maybe some tourism. And, it's just like, this is a cleansing thing. And I think, it's weird in this industry because everyone on Twitter is doing victory laps about everything. But if these guys were all so good, they'd all be in PJs, and they're not. I mean, they're selling you newsletters. They really need the $100 subscription.
That's right. They're in PJs. It's just not their private jets. They're in their pajamas.
Yeah, they're in grandma's house. And so, but there's this culture in our industry to never admit that you're kind of not hitting it as hard as you should be. And I think as a result, there's a lot of people that don't really know how to fix themselves. And I've seen friends totally self-destruct where they just start trading bigger and harder. And that's the wrong thing to do. I've seen a lot of things where you almost need to have an intervention on the guy. I mean, for me, I think it's important to step away and just look at what's not working and why. I tend to be a guy that owns these sort of mid cap things that tend to be tied to the economy. You know, I do well when GDP is growing, and I don't do so well because I don't short when GDP is negative.
Yeah.
And I think that the GDP, X tech and X AI is probably negative. It's probably been negative for over a year now.
Right.
And I think, when you take a step back and you're just kind of like, why is my stuff not working? Well, we're in a recession, and stupid me, I'm looking at the S&P and I'm not realizing we're in a recession. I mean, even they tricked me. And it really took to this season's earnings calls where I'm like, wow, it's brutal out there.
Right.
It's hard. I think the other really hard thing about this, and it's really, I think, important, is a lot of the time there's nothing to do. And we all want there to be something to do. And we all want there to be something we're really passionate about. We all want to be, 130 long and, just talking about your favorite things. Look, Buffett got to be really, really rich because he sits on cash. And about once every 10 years, guys come to him for capital and he disperses it and makes a lot of money. I mean, I'm not Buffett, but I can sit on cash also. And about every 5 to 10 years, the world almost dies. And about every 18 months, some sector dies. And there's plenty of opportunity, but you have to have cash when that comes. And I think the hardest thing I've ever seen, because when it was my own personal money, I would just sit in cash. The hardest thing possible is to run a hedge fund and LPs call you up. So what are we doing today? Oh, I went to the farm. I got a good surf in. I mean, I don't want people to think I'm not working because I'm working my ass off. I'm building an inventory of stuff I want to buy in 6 to 18 months.
Right.
But then you have employees, they want to put names on the book, and there's all these things. And I didn't realize how hard it is to do this at an institutional level as opposed to a private level.
Well, for you, it's hard at an institutional level, but it's even hard at a private level. Like, what's the line about there's nothing harder than watching your neighbor get rich? And that's in essence what's happening right now. I just, when you said that, there's so many great investors that just immediately sprung to my mind. Like, what was the market wizard guy that said something to the effect of, I just sit around waiting for there to be money in line there in the corner and I go pick it up. I think it might have been Jim Rogers.
Yeah, something like that.
Yeah. And then the other one I remember specifically is Barton Biggs. One of the two. Barton Biggs and Soros were chatting. And it must, I'm thinking it's Byron Wien now that I'm thinking about it. And Byron said something, Soros says, why are you in at work today? And Byron's like, well, what do you mean? Why am I in at work today? I work every day. And he goes, well, there's nothing going on. There's nothing to do, Soros says. And, Byron says the difference between me and you, George, is that when there's nothing to do, right? And the kind of implicit, wisdom in that was there was lots of times when there is nothing to do and you just need to wait.
Yeah, and waiting is really, really hard. Yeah. Look, there's a ton of cheap stocks I want to buy. I think they're going to get cheaper. I think there's a lot of things. I mean, look, event driven is great. I give a quick plug to Kedm.com. Go take a trial. I think there's always stuff to do in event driven because corporate actions are their own special thing, idiosyncratic to the world. But the stuff I do, tailwind investing, there's not a lot of tailwinds. So don't force it.
Yeah. Got it. Okay, listen, I'm going to spring something on you. I hope you're not going to be upset about this. Since you haven't been on in a while, and you're not, especially not as a proper guest. My recent things that I ask everyone is the desert island investing. Okay. And so the desert island investing, what it is, you're allowed 3 albums or 3 bands, and then 1 trader / portfolio manager from history. And it's just going to be you, the trader, and the 3 albums. So I hope you're okay with this. First of all, are the 3 bands. What are your 3 bands you would take to the desert island?
Oh, I'd probably take I don't know, just like Zeppelin or something.
Okay, Zeppelin, good choice. Okay,
I don't know, maybe Government Mule or something, a little hippie.
What is
the
that?
Almonds? I don't know, something like that.
What is Government Mule? Is that what you said?
Yeah. It's like an almond spin-off band.
You're going to the desert island and you're taking Government Mule? Okay. Anything else?
No, that's it. I take the
Okay.
almond. I don't
Now,
know.
okay, the Allman Brothers. Is that what you're saying?
All right, I probably have to take something angry, probably like Metallica or Nirvana or something to kind of balance out the hippie.
I'm actually surprised at how many traders so far have said like hard metal rock. Like it really actually is kind of shocking to me how traders must be an angry bunch. Okay, now
You ever have a bad day and you just put like Rob Street on?
you and the guy from Big Short, Christian Bale's character. Okay, so now the trader, you're not allowed to pick somebody that's already been picked, and so far Ed Thorpe and Druckenmiller have been picked. So you got to pick somebody other than Druckenmiller or Ed Thorpe.
I think I'd take Mark Faber. He's just the most interesting man alive. He is the most interesting man alive. I mean, we did at Kedem, we did a Kedem happy hour. I think it was like 4 a.m. in Chiang Mai, and he's like chain smoking and drinking a bourbon or something.
I'm just gonna leave that. I'm not gonna say anything to that. I just good old Kuppy could have picked Mark Faber. Okay, you know what the good news about picking Mark Faber is? I think you're gonna be alone in picking that.
What if you're gonna be on an island for a long time? He's really one of the most fascinating humans alive.
Okay, well, there you go. Harris, it's been a real pleasure having you on. Why don't you tell people where they can find your blog? Because they should all sign up for your blog. It's free. It's terrific. You've been knocking it out of the park. Tell them about your blog. Tell them about your Twitter account or your X account, whatever it's called, and tell them about for potential investors where they can reach out to learn more about your fund.
For my blog, go to pracap.com, PRACAP. Sign up for the blog. I mean, drop our email. We're not going to spam you or anything. If you go to the blog, there's also somewhere on that website a way to reach out to the investor relations guy, Nick, at my fund, and he'll tell you about our fund and how great we're doing. For X, go to @hcuppy.com. I hope you have some thick skin, though, because I'll find a way to offend everyone eventually. That's KEDM.com.
Oh, yeah, that's right.
That's our event-driven newsletter.
Okay, great. Well, Kuppy, it's great having you on. Thank you very much for taking the time to share this with us.
Hey, thanks for having me on as a bear for once.
That's true.
Doom and gloom sells.
That's right. Doom and gloom sells. Okay, thanks again, bud.